Building rural wealth, and this is kind of an interesting one to me. So, why business owners often overpay taxes? All right, Dan, tell me where we're going to start here.
We hear business owners sometimes, make the comment, why does it feel like I'm paying more taxes every single year? The business may be growing and income's up, yet the tax bill keeps getting bigger. Well, of course, those things kind of go together. The assumption is, well, if I'm paying more taxes, things must be getting better. And sometimes that's true, but it's not always the whole story. Sometimes we've seen where it means you may be leaving some opportunities on the table. And that's often because no one stepped back and just asked, are we being proactive with our tax planning, or are we tax planning, period, or are we just being reactive? In other words, I sold this, so I've got to pay X in taxes. So a lot of business owners are overpaying simply because oftentimes what we see are just missed strategies.
Yeah.
And so today we're going to walk through, where we've seen some of those missed opportunities show up. And again, this is not tax advice, just things that we have seen in our practice and in our firm, that when we work with business owners and situations that we've observed.
All right. Dan kind of alluded to it, Caleb, but tax filing versus tax planning. Talk to me about those two items there.
Yeah. If you kind of think about them and dig into them like we try to do with clients, those are two very separate things and very separate, functions, And a lot of it, most people think if I overpaid or the amount that they paid is by a mistake or it comes from a mistake. And that's that difference of filing taxes versus planning for taxes. If you kind of know where you're going to end up in the year, that whatever that tax bill is, if you kind of know where you're headed, isn't as big a surprise versus seeing what that is. And tax filing is reporting what's already happened. We've talked about this in the past. It's kind of looking backwards. That tax planning, or tax planning is making decisions before the year end that influences that outcome before it. Once you file your taxes, that's it's already done and, drawn in the sand. And if you think about it from a business owner's perspective, you don't wait until December to decide your pricing. You don't wait for that on your staffing, your inventory. You're looking at that in January and the year ahead, projecting it. And you make those decisions probably throughout the year too. You don't just make them one time. But when it comes to taxes, a lot of owners and a lot of just us individually unintentionally shift to that reactive mode, like Dan said. You're not looking forward. And, like everybody, you kind of in March bring everything into your CPA, the return gets prepared correctly, filed on time, everything is done by the book, so you think it's all good, everything is done. But by that point, a lot of those meaningful decisions have already happened, or they've been missed. And by that stage, it's really not strategy anymore. That tax filing then is just documentation. So you miss your planning opportunity. Mm-hmm. If you look at some of those planning opportunities or sit down with your CPA, your financial advisor, you can look at things as far as adjusting the timing of income, structuring your compensation of salary versus business dividends, maximizing retirement contributions, or just evaluating that business structure too. So again, a lot of those things you don't want to try to do right at the year end and jam in, but with a little bit of prep, look ahead and coordination between those professionals, you can kind of shift into that tax planning mode rather than that tax filing mode.
So tax filing, you're looking back. Tax planning, you're looking forward.
Yeah.
So, okay. What are some of the most common missed tax opportunities, Dan? What do we need to be thinking about here? We don't want to miss them. That's
right.
Yeah.
And again, these are just things that we've observed, in working with business owners over the years. If taxes often come from mixed strategies. The old thing, nothing's certain but death and taxes. And so it makes me think of this line I heard one time about. Henny Youngman once said, and I've said this on here before. Henny Youngman once said, I'm proud to be American and I'm proud to be an American and pay taxes, but I could be just as proud for half as much, And so, if we can find ways that we see business owners, some of the missed tax opportunities. Well, the first one on my list here is retirement plans as a strategy tool. A lot of business owners think of retirement contributions as something you do if there's money left over, or they look at them as a cost. Okay, now, yes, there are, costs that are involved with funding a retirement planning strategy or a retirement plan for your employees and for yourself. But oftentimes there are some really nice key tax strategy and tax saving opportunities that are involved with those. So I'll just give you an example here. Two owners, maybe they earn similar income, but let's say one puts a small amount into a SEPA IRA at the end of the year, but the other has a structured plan and contributes intentionally. that could potentially create a very different tax outcome for those two different owners. So, we always suggest that you try to consider if you're treating your retirement contributions as an afterthought or a part of your overall strategy. It's just like Caleb said a minute ago. You don't wait till the end of the year to figure out your pricing for the year or who you're going to hire and those type of things. So this needs to be a strategy you consider as you go as well. Potential opportunity number 2 is entity structure. And this is where your business structure made sense oftentimes at one point. Whenever people start out, maybe they were just a sole proprietor, or maybe they had a partner, so they were an informal partnership. And now your business has grown. Well, have you revisited your entity structure? Have you looked at, would there be advantages to me if I formed an LLC or if I formed a C Corp or an S Corp? What are some of the advantages or disadvantages of having one of those? Because there's different implications for each one. And so really encourage owners as their business grow to occasionally look at their entity structure to see if they're where they optimally should be from a tax standpoint. And then opportunity number 3 might come with timing of income and expenses, and Caleb touched on this. And this one is less about what you earn and more about when it shows up or when you have to include it in your taxable income. Income timing, expense timing, equipment purchases, these are decisions that can influence taxable income year to year. And oftentimes, small business owners, they may have cyclical income.
Yep.
And some years are better than others.
Yep.
So, you may want to, if you know that you're going to have a really good a really good income year, maybe you need to try to position some of those equipment purchases or income, or prepay some expenses and some things like that. Or maybe you needed to defer some income or change some contracts or something like that. Timing these strategies oftentimes don't eliminate taxes, but they can help manage when and how they're paid.
But the timing is very important in this.
Absolutely. So again, none of these opportunities are last minute decisions. And if the first time you think about your taxes is at the end of the year, like Caleb mentioned earlier, oftentimes there may be some missed opportunities. And and this can go for not just business owners. I mean, this can go for anybody out there, that's doing your tax planning, just professionals that are retiring from a position. If you had income, maybe you worked part of the year and you didn't work part of the year, would it make sense to do something like that if you're retiring from one of the factories or something? Yeah. So there's all kinds of timing issues that should be thought of if you're a rural business owner or a professional that's retiring.
All right. Dan mentioned it, Caleb. So what is the cost of waiting until the end of the year?
The longer you wait, the more limited those options just become. Again, you're trying to squeeze stuff in a finite amount of time. And those tax decisions, when they get compressed in a couple weeks or months, again, that's more of a reactionary decision, not a planning decision. Again, maybe you wait till November, December to actually, cut and make that decision. But if you've at least thought about in the prior months, I kind of say measure twice, cut once.
Yeah.
Do your measuring earlier in the year, and then if it is that decision time, like Dan said, November, December, do it, but why you're doing it then.
It's never too late to start working on it, but the earlier and the sooner the better, right?
That's right. And Aaron, let's face it, nobody wants to. I mean, nobody likes to think about paying taxes, period. Well, and once you get past, tax time, once you get past April 15th, which is the tax time for most people. I mean, there's other different ones, but most people are like, oh, I got that behind me, and they don't want to think about it.
Right.
But actually, just like Caleb said, now's actually a really good time to be thinking about what can I do to influence, the second half of the year here to help my taxes to lessen that effect next April 15th.
So kind of along that line, if you're running your business, we've talked about that, you're in the day-to-day working, sometimes you don't have time to sit down and think about all this, right?
That's right.
So what about working with all of my advisors to have them take care of it? Talk to me a little bit about that, Dan.
Well, I mean, it's very, very important to coordinate all this with your advisors. Who are we talking about? CPAs. We're talking about your financial advisor. We may be talking about an insurance advisor. You may be, talking about different people. And again, Your tax people, they just got to do it through with tax season. They're like, I don't want to think about it anymore. But again, it is very important to make sure you're doing that. So sometimes coordinating those things are so important, So let's say you are an owner that you do understand the importance of, your business structure, your entity structure, having a retirement plan and all those things. Oftentimes it just comes down to how is your advice structured?
Okay.
Who are you working with? For an example, you might have a CPA that's focused on minimizing taxes this year and a financial advisor that's focused on long-term growth. And maybe they're not really connecting and talking to each other. Well, that impact can be pretty unfortunate, if you're not working together. So what helps in one area short term doesn't always align with the long-term goals. So all of these decisions are connected. Looking at just one thing in a vacuum, is not, the best decision oftentimes.
Again, that's why you work with somebody, working with somebody that can kind of hopefully zoom out for you and help you see that 30,000-foot view, or take on some of that heavy lifting to do some of that tax return review and some of that planning for you to see what you need to do. Because like Dan said, the goal isn't just about paying the lowest amount of taxes possible. It's about this, having decisions that support your long-term goals, which are a myriad of things, which include paying, lower taxes, but, there are competing things within there. But, aggressively reducing taxable income, could feel good today, but it impacts, your retirement contributions, Social Security savings and benefits, lending opportunities, how your overall financial picture and health look, just depending on what your plan is.
Again, it's a balance out there, and that's where you got to work with all of your advisors to make sure that you have all these things in line together.